Hey everyone, welcome back to the channel. If you're looking for a safe, consistent, and stress-free way to generate passive income every week, this video is for you. Today, I'm reviewing one of my favorite option trading strategy, selling put option. Why should you care? Because this strategy allows you to collect cash upfront without even owning a stock, generate weekly or monthly income passively, potentially buying stocks you love at a discount. And the best part, this strategy is beginner friendly. By the end of this video, you will learn what selling put option is and how it works, how to choose the best stock and strike prices, a step-by-step guide on placing an order, how to avoid common mistakes and maximize profits. Make sure to hit that like button and subscribe so you don't miss my upcoming trading strategy. Let's dive in. What is a put option? Before we jump into selling put, let's cover the basic of put options. A put option is a contract that gives the buyer the right but not the obligation to sell a stock at a specific price, the strike price, before an expiration date. Step 1. What is an option? An option is a financial contract that gives the holder the right but not the obligation to buy or sell a stock at a specific price before a certain expiration date. Options come in two types. Call options give the right to buy a stock at a set price, used when you think the stock will go up. Put option give the right to sell a stock at a strike price, used when you think the stock will go down. In this video, we will focus on put options and more specifically, how to sell them to generate passive income. A put option is a contract that gives the buyer the right but not the obligation to sell a stock at a specific price called the strike price before an expiration date. The buyer pays a fee, which is the premium, to the seller in exchange for this right. The seller, which is us, collect the premium and agree to buy the stock at the strike price if the option is assigned. Key takeaway: a put option protects the buyer from a stock dropping in price, similar to how an insurance policy protects a car or a phone. As put seller, we are the one providing this contract and getting paid upfront. Selling put option is like having insurance. Example, let's simplify this with a real world example that everyone can understand. Let's simplify this with a real world example that everyone can understand. Imagine your friend has a brand new iPhone worth $1,000. Your friend is worried that he might drop and break their phone, so they ask you to insure their phone. You agree to buy their phone for $900 if anything happens to it within the next month. In exchange, your friend pays you $30 upfront for this promise. Now there's two possible scenarios. The first, if the phone never breaks, you keep the $30 for providing the insurance and nothing else happens. This is pure profit for you. If the phone breaks, you must buy it for $900 even though it is not worth much less. But remember, you already got $30 upfront, so your real cost is $870 instead of $900. You own the phone and you can now choose to repair it, resell it, or keep it. That $30 payment, that's called a premium, and that money you keep no matter what. In the stock market, selling a put option works exactly the same way. You are basically getting paid to agree to buy a stock at a lower price. How selling put option generate weekly income? Now let's go over how this actually make you passive income. Let's use a real world example. Stock example, selling a put options on Apple, ticker symbol AAPL. Apple current price is at 188 per share. You sell a put option with a strike price of 170. You receive a premium of $2 per share or $200 per contract. Expiration 7 days. Two possible outcomes. Stock stay above 170, the contract expire worthless and you get the full $200 premium. That's free money with no obligation. Second possible outcome. Stock drop below 170, you have to buy 100 shares at 170 each, but remember, you wanted this share anyway, and your real cost basis is 168 because of the $2 premium received. Either way, you win. This is why selling put is a powerful income strategy. Next step, I'll be explaining how to pick the right stock and strike prices. This is a critical step in selling put options successfully. If you pick the wrong stock or the wrong strike price, you could end up taking an unnecessary risk or even losing money. Step 1. Pick the right stock. When selling put options, we are essentially agreeing to buy a stock at a certain price, so we need to choose stock we are actually happy to own long term. What makes a stock good for selling put? Number 1. Blue chip stock, established, stable companies like Apple, Microsoft, Google, and Amazon. Number 2. Steady growth and profitability. Look for companies with strong earnings and increasing revenue. Number 3. Reasonable valuation. Avoid stocks that are overpriced or in a bubble. Number 4. Decent liquidity. Stock with high daily trading volume have tighter bid and ask spread and better option pricing. It's important to ask yourself that if you are happy owning this stock for the next 5 to 10 years. Stocks to avoid when selling put. High volatility stocks. Stocks with extreme price swing can quickly drop below your strike price, increasing your risk of assignment. Penny stocks and small cap stocks. These stocks are high speculative and often have low liquidity, making their option more expensive and less predictable. Companies with bad fundamentals. Avoid stock with declining revenue, heavy debt, or weak leadership. A good example will be GameStop. This stock has a very high volatility, which is very hard for option trading. Volatility refers to how much a stock price moves up and down. High volatility stocks have unpredictable price swing, often jumping or crashing by 5, 10%, or even 20% in a single day. For put seller, this is dangerous because if the stock suddenly crashes, you might be forced to buy it at a much higher price than it's worth. The put can be assigned to you unexpectedly, resulting in a huge paper loss. If volatility is high, option premiums are expensive, meaning investors may overpay for puts and increase risk. What are penny stocks and small caps? Penny stocks are companies trading under $5 per share with low market value, usually below 300 million. Small cap stocks are companies with market cap under 2 million, often in early stages or niche industrial. Why these stocks are bad for put selling? Number 1, they have low liquidity, fewer buyer and seller, so options are harder to trade. Number 2, unstable business model. Most penny stocks are speculative startups with no proven profits. Number 3, delisting risk. If a penny stock fall below $1, it could get delisted from the major exchange, making it impossible to trade. Number 4. Massive price manipulation. Many penny stocks are easily pumped and dumped, leading to a false spike before crashing. One good example would be the AMC, a speculative penny stock. When pumped by Reddit and meme trader in early 2021, AMC shot up from $2 to $7, then crashed back down. Financially, this stock is weak. AMC has billions in debt and struggled to survive post-pandemic. Unpredictable option market. This stock has high implied volatility, making AMC put option extremely risky. Why is it bad for put seller? When you sell a put option on AMC at $10 thinking it will stay at that price, it could suddenly drop to $5 due to bad earnings report or market panic. You are now stuck buying shares of a struggling company that might never recover. Better alternative, stick to middle cap or large cap stock that have strong fundamentals like Coca-Cola or Google. What are bad fundamentals? A company with bad fundamentals means it has declining revenue, sales are dropping year after year, heavy debt, the company owes billions and struggling to pay it back, weak leadership, poor management decision leading to business failure, no competitive advantage. The company couldn't compete with stronger rivals. Why this matter to put seller? If a company has poor financial, it is more likely to fail, meaning the stock price could crash. If you sell a put option on a weak company, you could end up buying shares of a dying business. A good example would be the Bed Bath & Beyond (BBBY), a dying retailer. Revenue plunged, sales has declined for years due to Amazon competition, bankruptcy risk. The company closed hundreds of stores and nearly collapsed in 2023. Stock price went to zero. BBBY stock fell from 30 to under $1, eventually going bankrupt. Why is it bad for put seller? If you sell a $10 put option, you will be forced to buy the stock at $10, even though the company went bankrupt and the stock became worthless. Better alternative, pick strong companies with stable earnings such as Johnson & Johnson or Visa. Let's have an example comparing Apple versus a speculative stocks like GameStop. Apple has consistent earnings, pay dividend, and have long-term growth. GameStop is highly volatility, speculative, and no real long-term value. Selling put on Apple equal safer. Selling put on Apple equal safer and more predictable. Selling put on GameStop, it will be risky and unpredictable. Now let's learn about choosing the right strike price. The strike price is the price at which you agree to buy the stock if the option is exercised. Picking the right strike price is key to managing risk and maximizing your probability of profit. Rule number 1. Pick a strike price below the current strike price. Always sell put at a strike price below the current strike price, which is out of the money. This reduces the risk of assignment and increase your chances of keeping the premium. Example, Apple is trading at 188 per share. Instead of selling a put strike price of 180, choose a strike price of 170 or lower. This way, Apple will have to drop below 170 before you are forced to buy it. Rule number 2. Use technical analysis to find support levels. Support levels are prices where a stock historically tend to bounce back up. Look for previous low points on the chart. Moving averages, example 50 days, 200 days moving average act as strong support, and RSI, relatively strength index indicator. A stock that is oversold is good for selling put when RSI is below 30. Best practice: sell put option at a strike price near a support level. Rule number 3. Use delta to find high probability strike price. Delta is a measure of how much option price move relative to the stock price. But in put selling, it also tells us the probability of the option expiring in the money, meaning the stock price fall below your strike. Pick strike price with a delta of 0.30 or lower. Delta 0.3 means you have 30% chance of assignment and 70% chance of keeping the premium. Delta of 0.5 equal 50-50 odds, which is not ideal for passive income. Delta 0.1 equal to very safe, which is 10% chance of assignment, but premiums are smaller. Example: Apple is trading at 188. The $70 strike put has a delta of 0.18. This means that you have only 18% chance of Apple dropping below 170. So there's a 82% chance that your put expire worthless and you get to keep the premium. Using data, let us balance risk and reward. Pick the right expiration date. The expiration date determines how long the put option is active. Choose the right time frame will impact the premium income. Longer expiration equal more money but higher risk. Flexibility, shorter expiration, faster turnover and less exposure. Weekly versus monthly expiration, which is better? Weekly expiration, it means 5 to 10 days. It will have faster premium collection, earning weekly income, less exposure to market fluctuation. If assigned, you can sell covered call quickly. Works well with high liquid stocks like Apple, Microsoft, and Amazon. The downside will it requires more active management. Monthly expiration, which is 30 days or more. Higher premium due to time decay. Less frequent trading, which is good for passive investors. Works well with slower moving blue chip stocks. The downside will be more exposure to market volatility. Which one should you pick? For active trader, weekly option is faster, premium collection. For passive investors, monthly option for less management. Final summary: the third step formula for choosing the right put option. Step 1. Pick a high quality stock, blue chip stocks with strong fundamentals. Avoid high volatility or speculative stocks. Step 2. Choose a safer strike price. Pick a strike price below current strike price. Look for support levels and delta under 0.3. Step 3. Select an expiration date. Weekly expiration equal faster income and lower risk. Monthly expiration equal higher premium and passive strategy. Using this strategy, you can safely generate passive income while protecting your downside risk. The last one that I'll be talking about will be the risk management and mistake to avoid. How to stay safe? Selling put is a great strategy, but there are some key risks to manage. Mistake number 1. Selling put on stocks you don't want to own. Mistake number 2. Selling too many contracts without enough buying power. Mistake number 3. Ignoring delta. A higher delta means higher risk. So when we talk about selling put option, you do not want to sell on stocks that you don't want to own. And when you are selling put option, you shouldn't sell naked put. It means that you do not have enough capital to cover the put option. This will involve using margin, If market like now, market is very volatile, so if you use margin too much, you will get liquidate. Pro tip, this is a pro tip. If a trade goes against you, you can roll the option to a later date to avoid assignment. And this is how you generate weekly passive income safely by selling put option. If this video helped you, smash that like button and subscribe for more trading strategy. Question for you. Have you tried selling put option before? What stock will you trade? Drop a comment below and I will respond. Want more in-depth trading tips? Check out my free guide in the description. Until next time, trade smart and stay profitable.